quick audio check. Everyone here, could everybody hear me loud and clear? All right, good. All right, so let me just introduce our next speaker. Ron Wheeler is one of the top analysts over there at eSignal. We've been doing, you probably see eSignal. eSignal's been around for, let me just get the recorder up, there we go. eSignal's been around, she's way before I've been even teaching. I think they're one of the pioneers when it came to the technology, when it came to trading in the market with their trading platform. Now, they're not a brokerage firm. It's a platform that you supplement with your trading system. And the thing what's nice about the eSignal, which I'm always a big fan of, you know, I do education for so many platforms out there, but they have to be one of the most, you know, one of the best ones that I've seen. And one of the best features that they have that a lot of them do not offer is the total view. And, you know, he'll be able to kind of go over that with you a little bit more on that platform. But also not just more understanding of the platform, but you really need to understand that if you're going to be trading, you have to make sure you have a custom page execution system that's more geared towards you and understand the strategies of what you need. And that's why, you know, we have an exclusive event where Ron's coming in here and eSignal helping and being a great channel partner of Cyber Trading University. So I don't want to take too much away from Ron. He's going to pick up where we left off. And then don't forget, we have 2 more speakers coming right after Ron. That'll be John Acornwell, and then obviously our very own Greg McDermott's going to talk about options right after that. So pass the mic over to Ron. Everyone enjoy. And like I said, any questions, feel free to put them in the chat. Ron, the stage is all yours.
All right, good afternoon, everybody. This is Ron Wheeler. I want to do a quick microphone check, too. I had to switch microphones at the last minute. So if you can hear me, just type a Y or yes in that chat window. That way I know everything is working good. All right, good deal. I'm going to go ahead and share my screen. Just give me one moment here. And all right, getting everything all set up. All right. Let me do this. All right, so I should be there. Yeah, eSignal is yes, eSignal is available, you know, around the world. You can always. I'll go ahead and I'll share this one screen with you. If you have any questions as far as the presentation goes, please feel free to talk to me in that chat window, of course, in the lower right-hand corner. But if you have any questions about eSignal ordering any of our products, I'll put this screen up here at the end as well. I didn't get a chance to upload it. I got a little bit late. But that's our number, and that's our website. That's the email that you can always talk to our salespeople at, and they would be glad to help you out, talk about the different things that we offer. Now, the purpose of my class and what I want to talk about a little bit today is trading in low volatility markets. Now, of course, volatility, the way I always interpret volatility is markets that are range bound. It's got a real tight volatility. It doesn't have a real big projection of price moving in either direction. This happens a lot during those summer months like your June, July, really late June, July, and August, when the market starts getting a little bit more tight. Now, it's not something that you're going to see all the time. You're not going to constantly have range-bound markets in the summer, but you need to develop a trading mindset to handle these range-bound markets. Now, we've all probably heard the expression, the trend is your friend. And it is. When the market is trending, it's easy to trade. It's easy to just take a place in the trend, whether it's at a breakout, whether it's at a retracement. It's very easy to trade trending markets. But when the market starts going range-bound is where it starts getting a little bit difficult, because you're going to start thinking it's trending. You're going to try to buy into the trend or sell into the trend. The market's just going to stagnate. So what we needed to do is we need to develop a system or a methodology to determine when are we trending, when are we range bound. Because when that happens, you as a trader need to adjust your trading strategies. And that's what it's really all about. You need to know when to switch from a trending mindset. Now, when I say a trending mindset, there's a couple of different parts of the trend that we're going to work from. You know, we're going to look for trend breakouts where the trends really just start. We're going to look for trend continuations. And that's usually, if you know about Fibonacci, you know, you'll see a market that's gone up 50 or 60 bucks a share, and all of a sudden it pulls back 10 bucks. Maybe it hits a 38% price retracement. That's a retracement in the trend. And then you also, as a trend trader, need to have some recognition of when the market's at a top. When are we at the end of a trend? Okay, so there's multi-components of a trend. But then also, you need to kind of figure out where the non-trending sequences are. Okay? All right, now, the way this all kind of comes together. In Advanced Get, we have a system of 5 trading strategies. And those 5 trading strategies all have their roots in Elliott Wave analysis. Now, today, I'm going to teach you trading strategies that have part of their roots in the Elliott Wave theory. But you're going to notice something that I'm not going to talk about is Elliott Wave. I'm not going to talk about Wave 3s and Wave 4s. This strategy, the false bar stochastic strategy, is a very, very nice strategy that takes the power of some of the Elliott Wave sequencing, but then also breaks these patterns down so you can see when they're not in an Elliott sequence, or when you can see that the markets have no volatility or they're in a sideways flat motion. And Fred's here, and if you have any questions, feel free to ask through the chat window, and I'll try to get to those as they come in. You don't have to wait and save until the end or anything like that. Fred, kind of. I do contracting for eSignal now. So I do some of their classes, and I do the Advanced Get mentoring again, kind of like the old days. And so I'm kind of working with them again in a limited role. All right, now, one of the things that I really want to stress to you as traders, when it comes to choosing and when it comes to looking at a chart, like right now, I've got a daily chart of AGN, Allergen, okay? What you have to kind of separate in your mind as a trader, it's not about finding every single market top and bottom, okay? So what you've got to be able to do is look at a chart like this, and I want you to be able to look at this and understand that there may not be a trading strategy that's going to get you short here, that's going to get you long here, that's going to get you short there, that's going to get you long, get you short, 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 okay? There's not going to be a trading strategy that takes advantage of every single market swing. There just isn't, okay? Well, I guess I'll rephrase that. There is, but then there comes the question of how many things do you want to monitor? Do you want to have 75 different trading strategies? And the problem with having that many trading strategies, you may say, sure, if it's going to get me every single market move, but the problem is you get into the real world, you've got 75 trading, and I'm being a little bit, out there with this by saying 75 trading strategies. I'm being a little bit, exaggerating there. But the problem is, as you add more and more and more to your trading style, you get more conflicts. All right, trading strategy A says this is a short. Trading strategy B says this is a buy. Which one do I believe? Okay. The problem happens as you start getting more and more analysis, and that comes into that term analysis paralysis. It's not good. So what we've got to do is we've got to isolate. I want to develop and I want to have a system that finds me highly repeatable market sequences. Now, everything in trading, and I can say this with a great deal of confidence, everything that you do in trading has a pro and a con, okay? So what I just talked about, we want to develop a system or have a system that gives us patterns that have a high degree of predictability and a high degree of repeatability. What's the upside of that? Well, the upside of that, of course, is we're going to see these patterns over and over again. They're going to have a high, degree of predictability, and they're repeatable. They happen quite a bit. What's the downside of this? It's not going to find every single market swing. There's going to be times when you look at a market and you're going to say to yourself, man, I wish I was short right now. But there was no repeatable, predictable market sequence that led into you getting short. Okay? There just wasn't. It's okay. When you're a trader, there's 3 trading decisions that you can make. You can be long, you can be short, or you can be flat. You have to be okay with that third one, being flat. If the market's moving down, it's moving down pretty quick, and there was just no opportunity for you to get short, all you can do is you just sit back and say, wow, what a ride that was. That was a big move. Maybe next time I'll get a sequence that takes advantage of that short. It's all about finding and waiting for consistent, repeatable market patterns. So in saying that, how do we do it? All right. What you have on the screen right here, AGN, this is a daily chart. All right. Oh, a couple questions that popped in there. I was kind of going off on a little tangent there. The advanced GET, G-E-T, that stands for GAN Elliott Trader. Okay. Remember how I talked a little bit about that everything I do has its roots in Elliott Wave? Well, that's GET, GAN Elliott Trader. I won't talk a lot about, actually, I probably won't talk at all about GAN today because GAN's a 3-day discussion, not an hour discussion. But I'm not even going to talk much about Elliott Wave, except maybe at the end I'll kind of tie it into what we look for with Elliott patterns as well. But it stands for GAN Elliott Trader. Okay. We have, and then as far as the data that goes back 10 years, it just depends on what you want to look at. You know, we have daily and historical data that goes back that far. Our, you know, our intraday data goes back, I believe it goes back 5 years. Let me go look here. Or I'm sorry, maybe it goes back like 6 months. I think our intraday data goes back 6 months, and then our daily data goes back years and years. So we should get more than 10 years out of that. All right. Now, what I want to do is I want to focus on this market sequence really right here on Allergen. Now, you're going to look at this, okay? Now, I'm going to draw some lines around this market sequence that I've got. I'm looking right now, and I want to concentrate on this part basically right through here. Now, you're going to say, why do you want to concentrate on that, Ron? That's trash. That's nothing. Well, yeah, you're right. That is. But there's money to be made there, too. Don't get me wrong. I want to trade this top, maybe. I want to try to trade this bottom. And I want to see these market swings go in place, too. And I'm going to show you how to get into those as well. But remember, what we're talking about is how do you manage markets that are very, very, you know, flat, low volatility market sequences. Okay. And all right, let me refresh my chart here. My data's coming in a little bit slow right now. There we go. All right. Needed to get my stochastic back in there. All right. Now, what I'm going to do, I'm going to use a stochastic. This is considered a slow stochastic. I'm going to spread the chart out, so just bear with me while I get it spread out to the appropriate range that I want to kind of deal with here. Same thing. 1 minute should go back 6 months as well. Intraday data should go back 6 minutes, or not 6 minutes, 6 months. 6 months of intraday data. Okay. All right. Now, the way that we're going to trade this, I'm going to introduce to you, and you guys probably are already familiar with the stochastic. It's one of the most widely used public domain indicators out there. I'm not going to get into the nuts and bolts of why, you know, what a 14 period this is and K and D and all that stuff. Don't worry too much about the nuts and bolts of it. If you want to research that after the class, by all means, go to Google and type in stochastic formula. It's not that I don't want to share it with you. I just, in an hour, I don't have time to get into the nuts and bolts. What I really want to do is I want to talk more about interpretation. How do we use this indicator? Now, a stochastic is, in my opinion, one of the best indicators to use for low volatility markets. It's got great range trading characteristics. It's one of the best studies out there for this. Now, on the bottom of your screen, you're seeing a 14-period stochastic, okay? 14.33 are the settings. Now, you guys might recognize a fast stochastic or a slow stochastic. This is considered a slow stochastic. Now, a lot of people look at that and say, why would you want to use a slow? You want to use a fast, right? Here's where it separates a little bit. I have always been the type of trader who falls under the guideline of indicators are to be used but not necessarily believed. Now, that saying goes back to Paul Tudor Jones in the 80s in an interview he did about why he can use technical analysis so much better than somebody else can. His one big tenet was when you have an indicator, you use it, but you don't necessarily believe it. All right? Now, that sounds kind of weird, I know, but here's the meaning behind that. Use the indicator. What's the indicator telling you? Okay? Let's talk about that. What is the stochastic telling you? Well, stochastic typically tells you when markets are overbought or oversold. When they're overbought, you should be looking to sell. When they're oversold, you should be looking to buy, okay? And areas where these markets are overbought, if you look at your stochastic, are areas where the stochastic comes above 75. These are overbought areas where I'm drawing these arrows, and these are market areas where you as a trader should be looking to get short, okay? All those areas right here. These are areas where you should want to be short and looking to get short. Now, where do you want to buy? Well, when the markets are oversold, kind of like here and here and here, when that stochastic drops below 25, these are areas where you want to buy. Now, historically, the way you're supposed to do it is like this. Now, one of the cool features of eSignal is we've got this replay mode. Now, this is not advanced yet specific. This is just an eSignal tool that you've got, right? It's called replay mode. I'm going to delete all these lines I put up there now that I've kind of got the chart to where I want it. And I'm going to take this chart back to about July 16th or so of last year. And I'm going to take this chart and make it look like it did that day, right about here. Okay? All right. Now, spreading it out a little bit. What you're seeing is you're seeing the stochastic start to rise above 75. The first line right there, the blue line, that's the leading line. That's always going to be above 75 first or below 25 second. The values on this one is 14.33. So it's a 14 period. I'll go to the properties real quick for you, and I'll just show you. There's the properties of the stochastic. It's a 14 length. I'm sorry, that's average range. 14 length, percent K is 3, percent D is 3. So just a 14.33 stochastic. Now, the way that you work this indicator, next bar comes in. All right, now you've got both the percent K and the percent D. Don't worry about K and D. You've got the red and you got the blue lines. Make this simple. Don't make it so complicated. The red and the blue lines are above 75. What this does, and for those of you located here in the States, if you're familiar with the National Weather Service, I always like using this, this description for this kind of stuff, right? I consider this right now a sell watch. Conditions are favorable in this market for the development of a shorting situation. I consider this trade right now a sell watch. Now, I bring that into the whole weather thing because here in the States, if you're not familiar, if you're not in the U.S., we have the National Weather Service, and they come out and they give us forecasts. You have a tornado watch. That means conditions are favorable for a development of a tornado. When it switches to a tornado warning, that means that there has been cloud rotation formed and there is an active tornado or the formation of a tornado happening. Now it's serious. Now it's real. Okay? You've got the watch and you've got the warning. Right now, my stochastic is above 75. This is a sell watch. Conditions are favorable for this trade to be shorted. Now, how do we transfer from a watch to a warning? Now, stochastic in its default mode teaches you this. When that red crosses above the blue, right here, this is where you would sell the market. The red line has crossed above the blue. This is a sell. So as a stochastic trader, you would be short on this bar right here. This is your short. Because the market is overbought, my stochastic is above 75, and now the red and the blue lines have crossed each other. Okay? So on this bar right here, you are selling. Now, go back to what I started with. Studies are to be used, but not necessarily believed. I do not think that this is a good place to sell AGN. A couple reasons for this. Number one, I want you to look at the bar. Okay? Look at that bar where you're supposed to short this market on. Just look, don't get complicated, don't look at anything else, just look at the bar. Look at where the open price is. The open, if you're not familiar with open, high, low, close bars, that little tick on the left is the open, that little tick on the right is the close. The market closed greater than the open. It went up a little bit that day. It didn't make new highs or make new lows, but nonetheless, the market went up. Do not short a market unless it's moving down. That is how you trigger a trading strategy. If you've got a trading strategy, whether it's a stochastic, whether it's an Elliott Wave, whether it's whatever it is, I don't care what indicator you're using, an indicator you create yourself. If the market is, or if the indicator is telling you to sell, you don't want to sell unless the market is actually in the mode of a sell-off. Now, how does a market sell off? Well, one of the first things is it's going to start making lows. Okay, it's going to go lower than the previous bar. Now, I want to be careful and don't say the previous day or anything like that, because it doesn't matter what time frame you're using. This could be a 1-minute chart. It could be a weekly chart for all I know. Okay, when I say I want to sell this market, I want to see the market drop below the previous bar's low. In this case, this is a daily chart, and we're going to switch over throughout the course, throughout the hour. I'll show you intraday charts too. I want to see the market drop below this bar right here in order for me to sell it. Or I'm not going to sell this market. It's not time yet. So when the next bar comes in, all right, based on the whole concept of trying to short this thing when the market's going down, I could very well see shorting the market on this bar at the very, very minimum. Okay, I could see shorting a market off of that bar right there. Now the close ends up right where the open is, but you notice the low of the bar, we actually went lower than the previous bar's low. We made a new low. We have a lower low. That right there is selling behavior. Okay, that's the first and minimal thing that you can look for when you have an indicator telling you to short. So right here, the stochastic above 75 is this is the sell condition. I didn't short it back here when we crossed over. I'm waiting for there to be some selling ideas going on there. And this is the earliest bar that you could actually sell that market. All right. Now, would you sell it there? Well, I mean, there's a couple other things you could do too. One of the other neat things we have in our software is called pivot points. And what these pivot points will allow you to do is really identify areas to where you can draw tools. Like it's hard to see right here in this little peach tone. Let me make that a little bit darker so it's easier to see. All right, now you see it right there. That's a J, that stands for a major pivot. What a lot of times I'll tell you to do is take a trend line or a trend channel from that major pivot and kind of draw it through. And you may not want to short that market until we're at least below that channel. Okay, so we could have shorted it there possibly. Well, still hasn't broken the channel. It finally breaks the channel right about here, and this is maybe where we can get a short. Now, this is, like I said, one of the tougher parts about trading is knowing where to get rid of that or where to actually sell the market. One of the things that I like to do is I'll look at previous bars as well. You take a look at this low right here. That's kind of a low that hasn't been taken out even when that bar sold off for the first time. Something like this, I would say, all right, I'll just draw a line straight over from here, and I won't sell that market until we take out that low. Okay, that's using the market's own support and resistance. Okay, so that's kind of what I'm looking right there. Yeah, and then some of the questions that popped in there. Yeah, it did close a little bit on that first bar. It did close a little bit higher. Now, one of the things that you also have to take into account is you don't know that at the time. You saw that the market closed there, but you're seeing it after the fact. You're seeing it after that day closed. In real time, here's kind of what you're seeing. You're seeing a bar that opens, a bar that's trading lower, and then in real time, you see this type of behavior. Okay, here's the previous bar, and oh, look, we're closed. We're closed below the previous bar's low, and this looks like selling behavior right here. Well, at the end of the day, what happens is, or at the end of that bar, the market's, kind of rallied from there and maybe closed right here. But at the time, you saw this. Now, like I said, this is a base or a minimum kind of a concept for you to actually get short this market. That right there would be a very, very aggressive entry. This one over here, when we break the trend line or break the trend channel right here, that would be a very conservative method. Okay, that would be a very conservative method. All right, so if you're waiting for the conservative, you're short right in this area right here. But see this right here, even this information right here, think about what stochastic and what a lot of public domain, for lack of a better word, traders have really known throughout the years, right? You're supposed to short the market here. You're supposed to short it here. Look at how many times stochastic is going back and forth, crossing over each other. And it stays above, 75 from July 15th all the way to July 29th right now. This thing is above 75, telling you to short the entire way. okay? And then finally, after all that time, it finally starts to sell off. You know, that's a lot. And then how much did it really sell off? Not a whole lot. It basically came back down to when the stochastic came below 25, right around here in the middle of August. So, okay, you shorted it somewhere in here at the cross of the channel at about 90.47. When it comes back below 25 right here, guess what? Same kind of pattern setting up. This is right around the time when you're going to end up having to reverse your position. Your stochastic is below 25. We have found, looks like, some support down here. Okay. Now, if you want to get a little bit technical, you can come in here and you can do some fib levels. I'm always a big fan of those. From that pivot, and you can kind of see the market's coming down to about 50% from that entire little run from that last pivot to pivot. Okay. You know, from this pivot to that pivot high right there, you're at about 50%. And that's usually a good run, 50 to 62%. Now, the market's giving you a buy signal. Okay. This is the characteristic, basically, of a low volatility sequence. We've sold off. We're stuck. The stochastic is now back below 25, telling you to buy it. Now, at this point, you just kind of have to repeat the process. A new trend line or a new trend channel. And if that thing can go up, there it is. Now, here's the problem with this low volatility sequence. It really hasn't gone anywhere. Take a look at that thing. This is the range that you have to deal with basically in this market. You have a range of here and here. That's your range. So if you're trying to buy this at the absolute earliest you could do it, it would be right here. And that price, as we take out the high, you're looking at about $88. And as soon as we get back to that previous high, you're looking at about $92. About a $3 or $4 move over a course of 2 days. Okay? You're stuck in a range-bound sequence. You've got the same thing happening here in August. Okay? Now you're back down, and now you've got levels to work with. You know the high, you know the low, and as soon as this thing gets back down here and gives you an indication of buying, right about here, I'd say, you can get back into it, and bottoms for a while, then boom, right back to that previous high. Now, if you're wondering, by the way, how you would put a stop in here and things like that, one of the methods that I like to teach at a base level is using the average true range. Okay? Use your average true range. This is a 14-bar average true range. If you're looking to buy into the market, you know, based off of this low right here at $87 or at $87.22, you know, you're getting long the market somewhere in here at about $88. Your average true range right there is roughly $1.69. Okay, so $1.69. And then what I like to do with my average true range, I'll take that $1.69 and I'll multiply it by 1.5. So that's going to be about a $2.50 stop from where you enter into. So if you're buying this market, you know, off of that low, which is right about here, maybe you're getting into it about 89.22, you're going to put a stop $2.05 below it. And, you know, give it a shot. That usually puts it out of the range of the market. It's a 14-bar average true range. You know, you put your stop below it with that average true range, and then now you've got the high. Here was the high couldn't get past. Here was the previous high couldn't get past. Here's the low. Here's the low. And we can buy them basically off of those levels back and forth. And let's see. That one did not quite get back to the previous low, okay, before it kind of came back and retested the previous high. Now, this is one of the tougher parts about trying to teach a strategy and all the things in an hour. What do you do in a case like this? The market's kind of steadily going down, but we're still not really getting, you know, below. We're not really making the transition. What I like to do is I'll go back and I'll look at the transitions in the past, okay? Look at the transitions in the past and how many days they took to happen. Here is where my stochastic last was at its high, right there, okay? This is kind of a cycle pattern that you can look at. All right, so here, off of right there, that was the last high and my stochastic is still above 75. All right. Now, where's my stochastic next below 25? It is right here. All right. Where is it next above 75? It's right here. Where is it next below 25? It's basically right here. All right. So what we need to do is we need to start actually, I take that back. Well, I don't take it back. I missed this one right here because it also is below 25 right there. All right. So take a look at how many bars were between those cycles. So we have got, let me go to my fib tool here. And let me make a real quick adjustment. I always like to make this a little bit thicker when I do the classes. All right. So let's take a look at how many bars. From here, from here to here, it was 10 bars. From here, where we finally made the high, it was 15 bars. So you've got a 12-bar sequence, and now you've got a 15-bar sequence. Well, what's half of that? We'll just call it 13, all right? When you're taking this next trade from that high, because that's the next sell, or even if you bought it down here, okay, or even if you bought it down here, it should take about 13 bars or so to get to the next cycle. That's how this cycle seems to be working, all right? And if you even want to, all right, well, let's say it was from here. All right, well, that's 24. 12 and 24, that's 36. Let's say at worst 18 bars, okay? What I'm going to do is I'm going to start watching this thing. We've got anywhere from, 15 to 20 bars on average, 12, and let's call the next one, right in there in that 15 from this low to that high. So let's just, what is it? When I start getting to that 12 to 15 bar area, which at this low, that's 13 bars, 14, 15, 16, 17, 18. Now look what's happening at 18, 19, 20 bars. This market is starting to move back around. And then right here even, we had to move below 25. So right in this area, you're already starting to get outside of the normal range of motion here. Okay? And it didn't come down and match the previous low. What's happening is the market is getting even more constricted now. Your range is tightening. You're a good 15 bars into this sequence right in this motion, and you're still not at the next low, and stochastic is dropping below 25. This bar right here is a good place for you to tighten up the trade. It's time to start getting out of that short, and I'm not going to say get long if you're already short and you want to try to give this trade a little bit more room. If you didn't have any position coming into this, I would say probably go ahead and get into a buying opportunity here for this next move up, but this is an area right here where you should be thinking about getting out of the position. It's starting to come back down. The stochastic is below 25, and in that range, we're 15 bars into it. The last sequence was 12. If you took it from that last low, even if you go from move to move, all right, even if you went from here we're below 25 to here we're below 25, that's only 9 bars. 12, 9, 15. 12, 9, and 15. Okay? All I'm doing is I'm measuring from where stochastic was above, where it was below. I'm going back and forth. That's the cycle nature of this market, 12, 9, 15. Okay? So basically, you're looking at 30, you're looking at 32, 33. Let's just call it 12 or 13 bars. You're not there. After 12, 13 bars, you're not there. You're not at the low. Okay? This market is not low. You need to start getting out of this position. 13 bars into it. Stochastic below 25 already, but we're not at the previous low. Good place to start locking up this position if you can. Especially when the next day in, you start seeing this kind of stuff. Okay? The next day has a higher low. The next day has a higher low. This bar doesn't have a higher low, but it's got a higher high. When you start seeing this consolidation right in here, now you know something's probably up. Not to mention you should be trying to get long from this low right here. Okay? This is, well, not from that leg. Right? This would be kind of like a little divergence, I would almost say right here. If this would have came down below 25 a little bit more, that would have been a nice little divergence area. Even this right here would have been some divergence from those 2 points. All right. So now as the market starts going up, all right, well, we need to try to find a short again. There's an area maybe where I would go short. You know, we made a new high. I'm not quite ready to get short yet. Maybe once we take out that bar's low, I could think about getting short. Okay, maybe right there. Okay, we're back below 25 again. Now take a look. Here's our previous low. That's a place to start thinking about taking some profits. And then a bounce. We can get long again. And now this market's really starting to come alive. All right. See how it happens? The range is now starting to contract. We didn't quite get down to this low, but we kind of figured that because the range contracted a little bit to here. And then the range again contracted to here. Now take a look here. All right. Take a look at the sequences of the markets now. You've got from here to here, 7, 12, 13, 7. Okay, so 7, 12, 13. All right, let's just call it 10 on average. I'm trying to average all these swings up. Let's call it about a 10-bar average right now. Now I want you to take a look at how many bars it basically took from the low to get right back to that new high. 4. From that low to that high, it took 4 bars. That's kind of a sign to me that this market may start going a little bit higher. Now, by the way, we're trading this August, September, October. It's already November now, okay? So theoretically, we should be out of that low volatility area. Now, this market, you know, really starts to run. And one of the ways that you knew that was because, look at the range. It expanded. These are all 10-bar trading areas. You know, we already said that was 12, 13. There was one that was like 11, 13, 9, 7. I'm averaging them all out, okay? Between where the stochastic went above 75, where it went below 25, I'm averaging all of these things out. And then right here, we had a 4-bar move. That tells you the market's expanding. We took out the previous high. We've expanded, okay? Now, this kind of leads into what's the beautiful thing about advanced get? Well, there's another indicator in advanced get on the stochastic that I haven't really even told you about. It's called the false bar. What the false bar does is it comes in here and kind of lets you know that the market is now going outside of the low volatility mode. I'm going to go into my stochastic indicator, into the properties, and I'm going to turn on this little thing called the false bar. It just says in the properties a bar. I'm going to turn that on. And what you're going to notice is it starts putting these black bars that'll appear either above the stochastic, like we saw here, or it will appear below the stochastic if I go back here. And what that does is it lets you know that the market is now moving outside of the normal compressed volatility, and we're getting into trend sequences. Okay, so what the market and what this false bar is telling us here, and why we call it the false bar. When you see the false bar, what that indicator is telling you is, hey, this market is no longer low volatility. We're switching to higher volatility. Higher volatility simply means expanded ranges, right? If any of you guys are options traders, you know implied volatility. When implied volatility increases, that means the traders are thinking that the market has a much, much higher range of potential price movement. That's kind of what it means here too. What's happening is this market is breaking out of a low volatility area, and it's now starting to move into higher volatilities. Okay? So what I want to see here is, as soon as that black bar appears right here, I say that this is not a good place to get into a stochastic trade like we did here, like we did here. So when I see that false bar up here, I would not want to sell this move right here. Now you're going to look at it and say, but Ron, if you would have shorted the market there, you'd have been okay. You'd have made a little bit of money. Yes, that's true. but that's not where the big money is. Once that market starts trending, get into the trend. Don't try and short trending behavior, especially when it's up, of course. If the market's in an uptrend, you need to switch your strategies and start looking for buying opportunities. That's where the money's going to be made. So what would you do in a situation like this? You would want to try to buy this market right here. This is where the powerful move is. You're going to try to buy it at around 90 bucks. This thing ran all the way up to about 100. It went up $10 a share. By the time this trade back here triggers, and by the time that low came in, right? Now here's the problem. You're going to try to short this market maybe at about 91 bucks. It went down to 88. Yeah, you made $3 there. But by the time this thing starts coming back around, you know, you're getting stopped out of the position somewhere in here, and you're going to just sit on your laurels and not take the next trade. The sequence has changed. Get out of the range bound. Yes, I know you missed a trade where you could have made $3. Sorry. But it was all in preparation to get into the one where it had a $10 move. And that was this one right here. Okay? Now, as the market starts trending, we're going to be repeating this process. The market starts going up. You'll notice that the false bar appears right here. That tells you, hey, this trend is in motion again. Don't try to short the market. Try to buy it. Where would you buy it? Fall back to your basic stochastic concepts. When that stochastic comes down below 25, like it does eventually, look at that thing. The thing just keeps going higher and higher. You had the opportunity to buy it in right here. Now, I'm going to be realistic. You're probably going to be, you know, out of the trade during this month and a half process here where it just goes sideways. I mean, if you want to try to rebuy it, there's strategies that I could introduce that could help you rebuy that. But at this point, you know, now you got to be sitting there thinking, all right, where's my next opportunity? Well, your next opportunity based on the stochastic was essentially right here in January of this year. You could have bought that market at 113 and saw it rally up to about 132. So here was the initial buy. There was the rally after it when the market started transitioning into trends. And now you can see it again. Here was the latest one, kind of coming into April and even kind of where we are now. You know, you had the opportunity to try to buy into this thing off of these two lows. Maybe you took a small loss right there. You had the opportunity to buy into Allergen at about 120, and that market rallied all the way to 170. And you had an opportunity to try to rebuy the pullback here at 160 after it marched up to about 172. Okay, maybe you got stopped out here. Maybe you took a small loss. Maybe you didn't get the whole move. Okay. Oh, okay. Yeah. That makes John. I just saw your comment there, and that's one of the things you'll actually kind of notice I have in the background too. I have an oscillator. So yeah, I know what you mean with that. I just wasn't thinking along those terms. But this is kind of how we now take an indicator and we transition from sideways, low volatility moves. We saw how we could really react during this entire sequence. This was about a 4-month process where that market was in a tight, narrow range. And one thing that you noticed about that whole process is when you look above there, there's no false bars. That's telling you the market's sideways. There's no false bars above, and there were no false bars below. Okay? Sideways, consolidation, non-trending. What do? Well, if you don't like trading, range-bound markets, don't trade it. Now, there's a lot of money sometimes being made in range-bound markets. Allergen, let's be honest, back then it was in a tight range. It was about a $4 range. But when you talk about a mover like a Google or Priceline or Apple or something like that, when the stock's $500-600, you know, these ranges might be $20, $30. You know, if you're looking at an intraday chart, you know, we can take a look at Apple on, let's say, a 60-minute chart. If I can find a range-bound area on Apple, which probably can't. All right, I'm gonna use this one kind of gratuitously, but this was actually a short right here on Apple back on May 14th. You have a false bar below telling you it's in a downtrend. This is a shorting opportunity at about 593. Well, when that market came back down on 516 and hit that low right there, that right there is kind of a range-bound market area. Well, on a 60-minute chart of Apple, That's a high of 596 and a low of 585. That's an $11 range where it kind of got stuck into. Okay, not bad, even for that range-bound sequence. Then, of course, what happens? Well, Apple breaks out of its trading range right in this area, and a new trend in Apple starts. Where was your next stochastic opportunity to buy into it? Oh, right about here on June 2nd, when Apple dipped down to about 625, and then it rallied up to 650. Now, for some of you that look at this chart and say, but Ron, you know, you would have probably missed this entire, no, you wouldn't have, because you could have got long here based on your stochastic. There's another indicator that we have in advanced get too called the XTL. It's a trend locating system, and this is kind of what the XTL looks like. Let me, I like to make this blue a little bit bluer. Okay, oops. Rookie mistake, forgot to hit apply. Blue, apply. There we go. And let me thicken the bars up a little bit. See when these bars are all turning blue? You've got a false bar. The bars are turning blue. This is an opportunity for you saying, hey, you know, if we can maybe rally above this, we can probably get long. Black bars are neutral, red bars are down, but blue bars are up. So when you see that false bar kick in, the bars are turning blue. This is telling you, hey, you know, you might have a shorting opportunity here. Or I'm sorry, a buying opportunity. I was looking at this one back here thinking short, and obviously not the right direction. Yeah, John, I'm with you on that. I'm pretty bullish on Apple myself. I have a mix of, I don't have any spreads or anything on it. I just got some calls bought at various months at various strikes. So I'm kind of with you. Hopefully Apple can get to, you know, 700. That'd be nice. Post-split. No, but, you know, when I say 700, I'm talking post-split. So we'll say 100. I'd like to see Apple get to about 100, and that would make my year. And if you got some spreads, probably yours too. And it does. It looks pretty bullish right here. Now, keep in mind, you know, we might get pullbacks, like this pullback back here in June. You know, that pullback was nothing worrisome. It was a nice little 38% pullback. You know, from a Fibonacci perspective, you know, nice little 38% pullback, nothing to be alarmed about. Now the market's kind of making a new high here. Now there is, you know, this is a 60-minute chart, so keep one thing in mind. A 60-minute chart is not going to be doom and gloom necessarily for longer-term plays like, you know, I have or what you may have. There is some resistance up here. This tool that I just added to the chart, this is a little bit of Gann, a little bit of Fibonacci. It's called our MOB, M-O-B, or make or break. That is a cluster, essentially, of Fibonacci and Gann resistance. So if you would have been buying Apple at about 630, we knew at that point that there was some resistance coming in at around 650. And that's kind of where we're stalled right now. Now, if you want to transition this into a little bit of Elliott Wave analysis, one of the things that I would be a little concerned with here is we are also on a 60-minute chart, mind you. This is a 60, so don't get too upset about this. We are kind of, you know, in a situation where we could be looking at a wave 5 right here. And at the end of wave 5, you typically would see some sort of corrective action, you know. So if you're in a spread right here, if this thing does have a correction, your deltas in your spread may kind of adjust here. Or I don't know, you might want to sell some calls or something like that. This does eventually become a top. Now, kind of getting into the Elliott thick of this, and I didn't want to get too much into Elliott Wave today, but Elliott Wave applies to a lot of this because that false bar and that blue XTL really does kind of lead you into understanding how Wave 3 operates in trend range and, you know, in trending markets. That false bar stochastic trade right here, that's typically your Wave 4. So it's kind of taking you into what the meat of Elliott is. Okay. So now again, this is a 60-minute chart, so don't get too, you know, oh no, I got to get rid of all my positions. If you want to look at something over the next year or so, you know, we would kick this up to like a weekly chart and get an idea. Whereas the weekly chart is, you know, says, hey, we still got some room. This was a big 4 pullback. You know, if we re-rally up to this fifth wave, and we're in a strong trend right now. We may see some retracements, but overall, we're looking at a $700 price off that previous high, and we're kind of marching towards it right now. I don't know. Ed, to your question about a drop after a split will be different this time, I hope it's going to be, obviously I'm long, so part of that answer is going to be because I already have a pre-built, bias. I'm hoping it's long because the market's a little bit different right now. The market's, pretty high. Things look pretty good. Apple's a glamour stock. Apple's got, let's be honest, Apple is Apple. They've got a lot of new products coming out. They just had a very successful developers conference. The iPhone 6 is coming. So they got some new products in the pipeline. It's going to be $100 a share, so a lot more people can afford it now. So, could I see a runoff of this thing? I could see a small runoff. I don't have, any delusions where I couldn't see a runoff, but I think the runoff might be profit taking. People taking their positions in Apple and maybe, liquidating it because they have a little more flexibility now because where they had 100 shares, now they have 700. But the key, of course, is will that be offset by the people that now have the buying power to buy Apple at $100 a share? So go figure. I will say this. If I do see Apple start into a retracement, I will not, and this kind of gets outside of what I'm doing in my class today, but, if I see Apple start to sell off and do a retracement, I'll convert my long positions where I've got calls, I'll just convert them to calendars, where I'll start shorting, some weekly options. I'll start selling some calls in the weekly to make up for my premium that I might be down over a long term. I'll just make it a calendar spread. Because overall, the chart is bullish. When we had this little decline from October to, the 3rd, you had an opportunity here. Okay, maybe you had some leaks or something on Apple. You could have been selling calls all the way through for a retracement and making money on the call side, and of course, slowly eating away the premium on the calls that you're on. That's for another discussion and topic, but that's kind of what I'll play it as if it does end up going down like that. Okay. Now, a couple other things about Advanced Get. One of the neat things that you can do with the software, we have a scanner that's built into the software that, and I've got it running right here. We can actually go in and we can scan for these patterns. I can say, show me on a 15-minute chart all potential stochastic buying situations. I'm going to do buying with the trend, which is a stochastic sort. And I can come in here and say, all right, let me tile my screen so you can see it. All right, here's one on Vail. These are 15-minute charts, mind you. All right, here you go. I'm going to take the Elliott off. Same situation. Look at that move on Vail back when the stochastic was below 25 back on the 5th. That thing ran from 12 bucks to 13. Well, now it's the same situation. We've got a new false bar on top, and we've got a stochastic now below 25. Now, this is a tight range now. You're talking 10, 15 cents. So let's see if there's any higher volume stocks that do this. Minimum 3-day average, let's say 2 bucks. All right, here's some bigger moving stocks. Continental Resources. All right, take a look at Continental Resources. Look at that move from the last time stochastic came below 25 back on June 5th. It rallied from 142 to 147. Well, now it's kind of consolidating back down at, stochastic below 20. This thing has the potential to run up. This is a 15-minute chart. This is something that can happen Monday or Tuesday to 147. And one of the things that I like to do on something like this, I'll take advantage of weekly options. If I see this pattern on a Monday, especially on something like an Apple or a Priceline, I'll buy that Friday's expiration and try to get in there, and just keep it for a couple days. And this is all done by the software. I'm going in here and trying to find these stochastic patterns. Here's QuestCore. All right. QuestCore right now is consolidating. It's low volatility. Take a look. Here was my previous stochastic high. We're trading at a stochastic low right about here. If this thing can bounce, we may see a run from $88 to $89. This is still kind of a tight range on QuestCore. Right? So, yeah, and then John, your comment there, sell some puts. Yeah, I mean, if the market stays in a bullish sequence, absolutely, sell some puts, you know, underneath it. What I like to do, and again, this gets outside of this, but trading in general, you know, I'll look for puts with a delta of less than about 30, and sell the puts less than 30, the delta less than 30. Or I'll do the same thing on the call side. If I'm going to do like a covered call or a calendar call, I'll sell calls with a delta below 30 because I have directional bias, so I can do that. If the market's going up, well, sell puts with a delta of less than 30. Low volatility for those to expire in the money, so you should be good to go. Okay. All right. So in the tone of advanced get, if advanced get is something that inspires you, looks kind of interesting for you, we do have a special. It's $700 off the purchase price. Now, advanced get is $39.95 if you do a one-time purchase. $39.90, one price, basically $4,000. You own it. Okay. eSignal, the 11.0 edition of eSignal, the advanced get indicator and studies for $39.95. You bought it. You own it. Never have to pay another, you know, software charge for that again. When from coming to our class today, there is a $700 off special. We do that for all of our seminar attendees. So that would knock the price down to $32.95. Now, with that $32.95, one thing I do want to mention, we have a 30-day return policy. So you could buy the software, try it out for 30 days. If you don't like it, we give you a refund. We also have month-to-month options as well. If you want to just do the software for a month and pay for it, it's $295 a month. Now, for that $295, that includes your eSignal, that includes your advanced get, so you have all the tools of eSignal 11, including the advanced get indicators. There is no 30-day money-back guarantee for the $295 option. You just pay it, and that's it. Now, one thing I also want to bring up, another thing I should say is advanced get also has real-time mentoring. What we do 3 times a week on Tuesdays, Wednesdays, and Thursdays, Tuesday evenings, and then Wednesday and Thursday during the trading day from 2 to 4 Eastern time, we have what's called advanced get mentoring. You come into a meeting room similar to this. Cyber Trading uses WebEx. We use Adobe Connect. You come into our Adobe room, and one of our presenters will be in there, either myself or Graham Ballard or one of our other guys will help you out. And what we can do is basically walk you through trading with advanced get. If you have a question, hey, Ron, I want to take a look at Apple today on the Stochastic. What did you think of it, or what have I done? Hey, Ron, I got long here, but I got stopped out of my trade. Was there anything I missed? It's your opportunity to really sit with a trader that trades with advanced get. You know, I've been using advanced get for 17 years. This is not something new to me. I grew up, so to speak, in trading with advanced get. I know the software from front to back. I'm also an experienced options trader. I'm an experienced futures trader, and, you know, so I've got a lot of experience across the board, and you will have access to me. I do a lot of the Tuesday night mentorings, so I'll be there on Tuesday from 6 to 8 Eastern time. And I also make myself available via email as well for any questions offline. Okay? So if it's something that's interested, you know, you can call us at the office, or you can email and have one of our sales guys get in touch with you, and we can kind of let you in on the some of the details of it. Yeah, there's not much in the spread trading kind of sequence on eSignal right now. Stay tuned. Stay tuned. There's some really exciting options tools coming with eSignal that you'll know about in the next probably 60 days. So stay tuned on that. And yeah, and then it does work on futures. Now, like I said, I'm kind of reaching the end of our time, so I don't want to take up any of anybody else's. One thing I will say, this works in anything. You know, I got my start with advanced get trading E-minis. You know, I did 3-minute charts and 5-minute charts with E-mini futures. We used to actually do a lot of live E-mini courses where we would trade with live crowds, you know, on 3-minute charts and 5-minute charts. So yes, it works beautifully on futures. We actually saw this trade, and if I remember what it was, what was it? I mean, I know what it was. It's a copper. Was it a 60-minute chart? We looked at this trade in mentoring on Tuesday of last week, or this week, which was on the 3rd. It was on a 15-minute chart or something, where we got into that, we were able to get into that big down move on copper, that overnight move. It was just a beautiful move. So yeah, it works on, futures, stocks, daily charts, weekly charts, 5-minute charts. It's universal. The patterns that I showed you today are universal of any type of market. And then quick question on that. The answer to that is yes. Now, there is one charge up and beyond the 32.95, by the way. There is a real-time data charge. That just depends on how much data and what real-time exchanges you need. Now that's something you talk to the salesperson about. But no, that's it. I mean, because you have to pay a month-to-month real-time data fee, that kind of includes your updates, so to speak. So there's no upgrade charges coming. You're kind of locked in based on the fact that, you have a real-time charge from eSignal every month to pay for the data. The data fee kind of locks you into the software fee, to the software upgrades. Okay. All right. If there's any other questions for me, by all means, I can give you guys my email address, and I can send you over to eSignal. Or if you guys want to chat with me, by all means, that's my email address you can get a hold of me at. But my time's at 10, so I don't want to take anybody else or get cut off. So I want to thank all of you for attending today. Hope you got to learn a little bit of stuff about how eSignal and Advanced Tech can help you navigate some of these low volatility markets and even some of the higher volatility markets as we come back into those trending areas. So best of success to all of you as traders. Hope to see you all again in the future, and thanks for your attention. I appreciate it.